On May 26, U.S. two-year yields were trading at 2.45%. 3 weeks later, that same rate printed almost 100 basis points higher to a rate of 3.42 before falling back a bit. Of course, the primary catalyst was the June 10th CPI number that blew away estimates and caused Fed expectations to change dramatically. In recent days, the CME FedWatch tool went from estimating an 80% chance of a 50 basis point hike at the June 15th meeting to now pricing in a 94% chance of a 75 basis point hike and a 90% chance of another 75 basis point hike at the meeting in late July. The PPI number released on June 14th, although slightly lower than expected, did nothing to change the notion that the Fed is going to be extremely aggressive in the coming months in an attempt to stop what appears to be rampant inflation. Of course, there are some who believe that the combination of higher rates, declining asset prices, and a potentially healing supply chain may soon bring inflation estimates down. Now, if a trader believes that the Fed will continue to be aggressive and raise short-end rates, they could express that by buying the CME June micro 2-year Treasury yield futures contract at 3.37 and target the psychological level above at 4.00. A stop for this trade could be placed at 2.95. This trade could make $630 if your target is reached and risks $420 if you're stopped out of your level. Now, if a trader believes that the Fed is being over-aggressive and perhaps rates will come back down, they could express that by selling the CME June micro 2-year Treasury yield futures contract at 3.37 and target a return to May highs of 2.82. A stop for this trade could be placed above at 3.60. This trade could make $550 if your target is reached and risks $230 if you're stopped out at your level.